Basically, last year, the dominant or the keywords for the for the world economy is inflation and hawkish monetary policies in the major economies. This year, things will be slightly different. In particular, I think we're already seeing the recessionary risk from both Europe and US are on the rise. But on the other hand, this year will also be the year of China's great reopening, in a sense that China will rebound, according to our forecast, very strongly from the second quarter this year, and the momentum can be carried into 2024. So I will just quickly share our views on how the situation will go. Basically, if you look at these slides, this will show our key forecast for 2023 and 2024. And overall, we see the world economic growth slow down from last year's 3.0% to 1.9% this year. And even for the next year, it's just a slight rebound from this year. I mentioned there's a rising in recessionary risk in Europe and the US. However, this time around, it will be most likely a shallow one. This year, China's reopening and rebound will provide a much needed growth driver for the world economy. And if we move on to look at our foreign exchange major forecast, we will see that basically US dollar, after experiencing a very strong year last year, will probably go into the period of, we call it chop and flop, in a sense that it probably soften for a bit, but as time goes by, it probably will come back a little bit toward the end of this year. And last year, because of the strong dollar, we have seen all the other major currencies, including British pounds, euro, yen, and renminbi as well, soften quite a bit, against US dollar. But this year, I think, some of those currencies will rebound, against US dollar. I think for the reason for US dollar's strength in the majority of the months last year, and then slightly correct toward the end of 2022, lie in the following. The first is that we have seen last year had been a quite turbulent year, starting with the Russian-Ukraine crisis at the beginning of the year, and consequently we see energy crisis basically coming from the supply disruption, and also the Omicron and cases reap through many of the regions, including toward the end of the year, China as well. So lots of uncertainties are rising in the worldwide environment to the extent that we start to see there's a certain period of time even higher risk-off kind of sentiment, and whenever there's a risk-off sentiment, those currencies, the so-called hard currencies, tend to benefit. So U.S. dollar is the dominant currency benefiting from such kind of trend. At the same time, we also see the inflationary pressure in U.S. actually tend to be quite high, which I will cover in the next few slides, which has led to a very hawkish monetary policy by the Fed. Actually, this is the most hawkish move by the Fed over the past several decades. And as a result, we see the yield of the U.S. Treasury against our other major treasuries tend to be much higher. And as a result, that push up the U.S. dollar. And the third reason is basically, despite the changes I mentioned just now, actually the U.S. economy tend to be quite resilient, in particular reflected by the labor market. So that is also part of the factor behind the strong US dollar. But coming into this year, some of the situation is changing. In particular, we start to see the inflation, although only just 2 data points seem to suggest has peaked out in US, and with the rising recessionary pressure, probably Fed would have to start balance the two main goals to maintain the price stability as well as to ensure the full employment. So as a result, a less hawkish Fed hopefully will will give us a easier time, especially from an emerging market perspective, and that will pin down the U.S. relatively softened move this year. So I'll quickly cover U.S. and Europe before I move on to the outlook for China. So for the U.S., I have mentioned that the inflationary pressure seemed to be quite high. And for U.S. perspective, because the Federal Reserve for a long time keeps saying the inflationary pressure is transitory, probably until November 2020, before central bankers started to change their attitude. And in order to keep the inflation in check, they have started a very hawkish monetary policy move. And we start to see toward the end of this, the left chart, we start to see, basically the inflationary pressure come down a little bit, especially for the goods. But when we talk about the services, we still see very strong price pressure. And in particular, the labor market seems to be quite strong. On the right-hand side, you'll see the chart basically showing the job openings versus the unemployed. You can think about that as, basically the supply in the labor market. And apparently, what this picture shows us is we have a situation where supply is not enough to match the demand, despite the fact we have heard the news talking about some major tech firms start to, lay off its staff. But that being said, we still see overall in the whole economy, U.S. labor market continue to be very strong. So this ends up being the situation where usually central bankers worry the most. That is, the wage and price could, constitute a situation of a virtuous cycle, if you will, to push up each other. And that is the situation U.S. actually experienced toward the end of 1980s. And that tended to be a hard lesson for the Fed to learn, especially because they tended to stop hiking earlier than needed to the situation that inflation eventually just run away in inflation, and then Fed had to hike to double digit in order to contain the inflation. Because of that, I think overall the Federal Reserve tend to have a hawkish bias in the sense that they want to make sure they can contain the inflation before they think about the labor market situation, the economy as a whole. And this time around, because of the labor market has this supply less than demand kind of situation, they can delay the decision to turn dovish a little bit. And according to our current forecast, Fed probably will hike one more time in February by 50 basis points. And after that, probably the kind of the negative impact on the economy will be more obvious. And then Fed will probably adopt a hold kind of attitude and see what's going on to decide whether they will make a cut if necessary. But that being said, we think probably it will take another 1.5 years until the third quarter of 2024 before Fed will seriously consider cutting its interest rate, which basically means the high interest rate situation will stay as it is for the next year or so. And if you look at the right-hand side, basically I cover it very briefly at the beginning of the presentation. That is a US dollar situation. And you can see from for the first 9 months, the gray bar shows that the US dollar had become one of the best years for US dollar after 1980s. However, toward the end of the year, US dollar actually correct for a bit. So toward the end of the year, we still see for the whole year, US dollar, the index increased quite a bit, but not as much as the first 3 quarters. And the situation, as we can see for the U.S. consumers, actually they still keep buying. In particular, their demand start to rotate from goods and to services, and this is a natural reaction after the economy normalized from the pandemic. Basically when people, after about 2 years of good consumption supported by the large money handouts from the government, finally, when they can go travel again or go to the restaurant or go watch a soccer game, people choose to do so. So that's also consistent with what we have seen from the inflationary data, basically in terms of the goods prices that had started to soften. However, the service prices stay elevated. And when we talk about the situation in Europe, I think, there's some similarities and differences. The similarity is basically the inflationary pressure also seemed to be quite acute in the Europe. And at the same time, the labor market probably not as strong as in the US, but still show quite some resilience. I think the big difference between US and Europe is that the Europe economy isn't so resilient to start with. And also in terms of the inflationary profile, actually the energy prices, especially, the situation from the Russia-Ukraine conflict, basically means energy crisis is a more serious problem, Europe is facing. And as a result, we can see basically, the Europe inflation already hit the double digit. And the ECB are saying they're trying to, they continue to be very hawkish. They try to bring the inflation back to the target, which is around 2% in the next 2 years. But if we look at the history, only a handful of cases we see in the Western countries, they can bring down the inflation from 10 to 2 within a 2-year time. It's not impossible, but that will be very difficult. And also that means this time might be different. So we'll have to see whether they will succeed. At the same time, because they start to, move very aggressively on the monetary policy front, that started to hurt the consumer confidence. And also as the consumers spend most of their accrued savings during the pandemic, the purchasing power won't be as strong as before. And for the mainland China, I think, the China reopening will be the dominant theme this year and into next year. And this is not just a story for China. It also has lots of implication and spillover effect for the rest of the world. In particular, we actually now forecast a 5.0% growth for this year and 5.8% growth for next year. To be honest, given China's reopening happened much faster than most expected, there is still some upside risk to our forecast number. And basically, we see the reopening already start, although China onshore is still battling the worst outbreak. We have seen some mega cities, including Beijing, Shanghai, Chongqing, Chengdu, already past the peak of the first wave, and people already start to enthusiastically booking tickets. And soon after China's border reopen, meaning they no longer require quarantine for inbound travelers, we'll probably see Chinese visitors all across the world very soon. And with that, the boom in other business sectors will follow as well. So I think, I just talk about COVID. That tend to be one of the major kind of hurdle for China's economic growth last year. And that one, at least we can say, according to other economists' experience, probably in the next quarter or so, China can emerge from the COVID, and we will expect a strong rebound. Another, headwind, which had been quite stiff for most of last year, was the property market situation. And for that, we have heard lots of news about developers' default on US dollar bond in Hong Kong, and also, some mortgage boycott. But again, we think the worst timing for the property market and the property developers as a whole also has passed, in the sense that we start to see the policy pivot since November last year. And basically, at the central government level, they have issued lots of measures trying to ensure developers would have access to funding through either the bank loan, shadow loan, or from the capital market. And at the local government level, we see more and more cities try to decrease the requirement for down payment, also, trying to lift some of the purchase restrictions they imposed early on. So with the demand and supply side kind of support, both play in favor of the property market, we think the impact of the policy combination will be more material after China emerged from the COVID. After all, the home purchase will normally require lots of offline interactions. So that can happen. And also, because of that, we think the consumption will be on fire for the year. And we have seen ever since the pandemic, the consumption had been quite sluggish. I think many reasons go behind it, and some important ones include, basically the sentiment, as people cannot expect reliably what will happen next. Their natural reaction is trying to save for the rainy days, and because of that, we see last year after the Shanghai lockdown, the consumer confidence actually dipped quite a bit. And because the lockdown has been on and off in different places in China for most of the second half of the year, so we didn't really see the rebound or improvement for the consumer sentiment. However, that could change now that China has entered decisively into the reopening stage. And another reason, holding back the consumption is the labor market situation. As you can see from the chart on the right-hand side, actually, the unemployment rate, especially among the young people, tend to be quite high, double-digit for most of last year. And even if we see a slight improvement toward the end of the year, it still stay above 17%. Usually the young people tend to have a higher propensity to spend. So when they cannot find a job, they probably cut down their spending quite a bit. However, now the situation is changing. The economy will soon recover. We will see basically that will already become the tailwind for consumption. And on top of that, if you look at the chart on the left-hand side, that basically shows the kind of the excess saving during the pandemic. And in 2020 and 2022, we have seen quite some excess saving compared to the historical trend. As a result, those excess saving accrued, according to our estimate, around 6.6 trillion renminbi can be used as additional ammunition when it comes to revenge spending. So, that's very important, especially given we just talked about the externally, the recessionary pressure is rising, which means external demand probably will be soft this year. So the net export won't be as strong a support or driver for the economic growth, and China will have to rely more on domestic consumption for the whole recovery story. And I think many people ask us, how do we see the inflation play out in China, especially after we observe U.S., Europe entering into the stage of, quite concerned about the runaway inflation. I think, China's case could be quite different. Of course, the reflation pressure is there for both CPI and PPI. However, given that China has an obvious negative output gap, will probably grow by 3% this year compared to historically, China's number will, aside from 2020, will be above 6%. So negative output gap is obvious. The labor market still has quite some slack to absorb. we actually think the inflation in China will be quite contained. And because of that, the government actually can focus a lot on growth. So the expansionary fiscal policies will take the lead, and we will also see monetary policy being accommodative. And when it comes to the regulation, I think China has taken a lesson from its 2021 experience, where we saw lots of tightening in different sectors. So from now on, based on the speeches by top government officials, they will try to make sure the regulation can be implemented in a way more transparent, and also make sure there's better collaboration across different agencies. And with that, we think China's economy can grow by 5% next year and 5.8% in 2023, and 5.8% the next year. So I'll stop here.